Welcome to the 10 Mil Club Standard Portfolio meeting for the third week of June, 2026.
From Nashville,
It's a 10 Mil Club. It's a 10 Mil Club.
Welcome to the 10 Mil Club's Standard Portfolio meeting for the third week of June, 2026. The 10 Mil Club is an informal group of people who believe that if we could get to $10 million of net wealth, we would have the financial freedom that we really desire. And if you are someone who believes that, you are in the 10 Mil Club, and we welcome you. This week, we got our first taste of what life is going to be like under a new Fed chair. To not go into it too deeply, but to go into it enough, the Federal Reserve, pretty much since the financial crisis of 2008-09, has been very accommodative. Through the Janet Yellen and Jay Powell eras, the Federal Reserve has been, many would say, and there is an argument for this, that interest rates and really yield curve control has been kept too low for a very long time, and it's been very accommodative, which has caused, it depends on the way you look at it, an asset bubble, higher asset prices, an overvalued market, high values in the market, lots of different points of argument. 3 years ago, so we are real estate appraisers, that's our central point of impact here at the 10 Mil Club. I went to a symposium that was put on by the Tennessee chapter of the Appraisal Institute, and every single year they have a gentleman there by the name of Dr. Thomas Paine. Here he is, Dr. Thomas Paine. He is an economist, but he is also the dean of the College of Business of Tennessee Tech University in Cookeville, Tennessee. And he is far and away every year the most interesting speaker in the whole thing. And there are a lot of speakers in the whole thing. But as interest rates were being raised, specifically the effective federal funds rate in 2022, inflation was high by United States standards. I think we were still somewhere around 7.5% that were being raised. We're trying to bring inflation down. And the mention from the Federal Reserve was inflation is transitory and we should have it under control. They were projecting in some cases a year and a half, that sort of thing. And Dr. Paine, if you're out there listening to this, all respect to you. You have a very interesting and very insightful way of putting this. He said, we know from past studies, paraphrasing very badly, I'm sure, we know from past studies that as you get down to that last 100 basis points or so of inflation, trying to get down to the 2% target, that it gets very difficult. And the reason is because of the service economy. You get to that service industry layer, and that last layer is very stubborn. So if they think that they're going to be able to bring 8% inflation down to 2%, in the space of 1 year, they'll bring it down a lot, but that last bit will be very stubborn. And it's funny, we got into 2025 and the Federal Reserve began cutting the effective federal funds rate and stopping the exhaustion of assets on their balance sheet well in advance of inflation actually being under control. And the narrative they gave us was we have to kind of start doing that now because macroeconomics are kind of like a big ship. They take a lot to turn around. Dr. Paine was a bit more on the demurring side of that. And as it turns out, inflation has not gotten down to the 2% level. Our president has nominated a new head of the Fed, and things are obviously going to be different going forward. We are now not going to get a lot of decisions telegraphed in advance. There's a full review with some task forces that are happening. The Federal Reserve is going to operate differently, and some of the outlook with some of the much more terse and less verbose verbiage that we got in the announcement this past week was that we need to get down to the 2% level, and this might actually be somewhat painful. So here we go. It looks like interest rates are going to go up. At least they didn't raise interest rates at this federal meeting, FOMC meeting, but this is early in the process. Market took a dive right there at the end of the day and stopped us out here at the 10 Mil Club with a lot of our investments that we had. It was a frustrating week in that account, but we survived it, I think, but we got stopped out of a whole bunch of stuff. But if interest rates are going up, that means that stocks, especially the S&P 500, is likely to have downward pressure on it. So will fixed income assets, and there are hedge fund managers out there that are constrained to put money in stocks. If that's the case, we know from financial theory, which they taught it to me in the CFA program, but we know through financial theory and even empirical data that non-investment grade assets are far less sensitive to interest rate policy changes and movements than investment grade assets. And where are there non-investment grade assets? At least in stocks, if you're constrained to put your money in stocks, small caps. And so what we are seeing is, if you've watched Dave Keller, which I hang on Dave Keller's every word, we watch him every day here, he's been pointing out every day that we're seeing breadth increasing in small caps for equities and decreasing generally in large caps. The reason for that, I believe, is because if interest rates are going to go up and hedge fund managers, people who move billions of dollars around, are constrained to put money in stocks, then we're going to see small caps be picked and chosen individually for fundamentals that are desirable, and that money will rotate out of large caps. And so that's kind of where we need to be. So with that, let's get to it.
10 Mil Club.
Let's start with the put-call ratio for all S&P 500 constituents. Now, on the surface, the put-call ratio for all S&P 500 constituents, you would think if the puts divided by calls, if the put-call ratio went up on the surface, you would think that would mean that the market becomes more bearish. It's kind of viewed, though, as a contrarian index. You can see here, this is a little tough to read, but if you look at the 21-day moving average, which is this burnt orange line in the middle of it, you can actually see that line increase. So the put call ratio has actually increased a bit on the more recent data, which indicates on the surface that it's more of a bearish market, but generally it's viewed as being wrong and being contrarian. This is one that really we look at every week. So this is the percent of S&P 500 companies trading above their 200-day moving average. You can see we took a hit right here in the last 2 days of last week. That's the aftermath of the Fed decision and the day after. This is the percent of S&P 500 companies trading above their 50-day simple moving average. There's the hit, and then Friday is just treading water largely. This is one I picked, though, for today's view. This is really tough to read, so stick with me. This is the Russell 2000 advance decline line. That's advancers to decliners. The most important thing to look at, again, we have the burnt orange line in the middle, which rises, and this is the yellow one is the 50-day moving average. Now, the Russell 2000. In the pantheon of stocks that are out there, you have the Russell 3000, which is most of the market. It's like 95% of the market, maybe more than that. The Russell 1000 are the largest 1000 in the Russell 3000. The Russell 2000 are the smallest 2000. So what you're seeing here is an increase in breadth. The back over here, this is May. The simple moving average is about 38 to 50, somewhere around in there. The simple moving average, the 50-day simple moving average, when we get over toward now, toward the middle to passing the middle of June, we're more in the 90s. So you're seeing breadth increase in the small caps. That is in keeping with my discussion before the break. All right, the stocks for this week, here we go. So APG, we're still watching. We have the upward momentum here. What we don't have is a cross of the DI plus over the DI minus, but we do have an increase in volume, an RSI pointed the right direction. We'll be watching APG this week. Byrna is in here. Now, this is an interesting company. If you take a whole year of Byrna, 1 year, 1 day, we unsuccessfully attempted to trade Byrna back over here. This is a non-lethal self-defense company. We unsuccessfully tried to trade it back over this way. It only has 22.5 million shares to it. And for some reason, probably growth concerns, the company, which doesn't have, for a small cap, just does not have a bad fundamental screen. Sold off, sold off, sold off. And now here it is crossing right there. And what we're starting to get now, I'm going to go back to 6 months. What we're starting to get now, the 200-day moving average is still up this way. That's true. But the 21-day EMA crossed above the 50-day. The DI plus has been above the DI minus, and they crossed back down right through here, so that's not exactly a good signal. But the RSI has been showing better strength. We're keeping an eye on this stock because, honestly, Byrna could end up being a very valuable stock in the next few years. We have not bought Byrna yet, BYRN. Commercial Metals Corporation. So we sold out, we got stopped out, actually, of CMC this past week. Over 45 days, we had a 6.6% gain. That's nowhere near the amount of gain we had. This was us getting pummeled by the Fed decision. We got stopped out at a 6.6% gain over 45 days. Not bad, but when you see all the small losses we had and one not too small loss because there wasn't much we can do about it, you'll see that we're not too terribly pleased. But such is the nature of volatility in the common equities markets. But out of CMC, COCO, Vita COCO, we actually bought and are currently down just ever so slightly, 0.21%. I think what we're thinking on this is a set of Fibonacci numbers. Now, I understand all of the voodoo claims about Fibonacci numbers, but with this break here, our thinking is that Vita COCO probably should run enough to make it worth our while to hold it. So COCO, we are in. We bought this week at 84.20. If you want Vita COCO, it's still there for the having. CVS we bought kind of high. Now this one we voluntarily sold. We went ahead and took a 2.64% gain over 14 days. And we went ahead and sold it because honestly, if it does another retracement that looks like this, we bought it high enough that we don't really have them. We bought it at 96.36 and sold it at 98.90. We don't really have the pricing to be able to absorb a retracement of that level like it went through back here from May all the way down to early June. And so we'll keep an eye on it. It's on the list, but we are out. We took a small gain on it. DG, Dollar General. This was one where we got clobbered by the Fed. You can see it right here, and it's especially annoying. This was actually not the most annoying thing that happened to us all week. You can see it recover and actually be above where we bought it. We bought it at, no, I'm sorry, it's not above where we bought it. We bought it at 118, but it's above where we sold it at 109. We were seeing pretty good. We were seeing the DI plus rise and cross through here. We were seeing the RSI point the right direction through here. We were seeing increasing volume, and we were seeing a cross of this line and a reestablishment of a direction. And for all I know, we'll be sorry we were stopped out, but them's the rules. That's what we have to live by. And so we took a small loss of, it wasn't a small one, a 7.5% loss on getting stopped out because we just simply got broadsided by what happened with the Fed's decision. Duolingo, DUOL. We are now in Duolingo. We bought it this week. We bought it at 128.50. You can see that right here. Duolingo has this interesting past. If you pull up 2 years of Duolingo, you'll see that Duolingo was a darling of the market. This area, I don't know if it was commensurate with or simply concomitant with their announcement that they were going to start using AI in their algorithm, and the market and the stock came down, 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 down. I will tell you that over that period of time, I'm a Duolingo user. I'm a free user. They really started treating their free people very, very poorly. It used to be that you could do things like do a review lesson in order to get hearts and not have to. Now you just have to watch ads, and I'm just not for it. So I barely kept a streak alive day in and day out, and have wondered why I do that a lot. They've begun being a lot nicer to their free members, but the funny thing is, winning sanitizes everything. And the truth of the matter is, if their stock hadn't dropped all the way from $540 a share all the way down to $87 a share, I don't think they would have done a thing. And so here they are now going, oh, no, we've got to be nicer to people. Oh, what do you know? Service matters. And the stock has taken a turn and is now showing better fundamentals. On a weekly basis, we're now seeing the DI plus turn up and the DI minus turn down, and the RSI continue. If you look on a daily basis, like 6 months, 1 day, you have the crosses you want and the technicals that you want. We are down 2.3%, but again, the later part of the week clobbered us. We are not stopped out. Our stop is actually set at 118.86, so we're a little bit from that. We should be okay. Now, I'm going to pause here just for a second. We have a Facebook page for the 10 Mil Club. There was nowhere that I could find that really wanted our videos or our links to our videos. So there's now a 10 Mil Club Facebook page. If I can remember to do it, I will put that link down below after this video is uploaded. There's also a group. We welcome you to join. At the end of every day in both of them, I try to put what happened during the day. I can't do it in real time during the day. I just don't have that kind of time because I do have a day job. But please subscribe to our YouTube channel. Please give us a like on this video, and please join our Facebook pages so you can kind of join the discussion. We would love to hear what stocks you want to hear about, and we will absolutely get into it if you'll just give us some posts. EVC, Intravision, we still are watching. If you go to 1 month, 1 hour, you can still see the uptrend in place. We made a small profit here and then didn't buy it when it got back down into this area. Probably should have, or waiting for a return to that area. We still have EXPD on the list. This is 1 year of EXPD. It took a down here after the Fed decision. Now, again, if the outlook becomes, whether the Fed actually does it or not, if the outlook becomes that interest rates are going to rise, you will see stocks go down. And we're going to look at Walmart in a minute. We'll talk about how that's affecting stocks like that. So we're going to be treading a little bit lightly here at TMC over the next little bit. But EXPD, waiting for some sort of entry because it's a pretty good quality stock, got the uptrends we like. And a DI plus on top of a DI minus, relatively high, not 70, but relatively strong RSI. Ford, we got stopped out of this past week for a 5.3% loss over 3 days. Very, very annoying. You can see, let's go to 3 months here. 3 months, 1 day. You can see Ford came down. It then did this turn. You could see technicals kind of turn the right direction. We bought, set a stop, and exactly 3 days later, the Fed announcement clobbered us, and next thing we knew, we were out. I don't know. Maybe here at TMC we should be able to see stuff like that coming a little better. To be honest with you, I don't know. Had the Fed decision cheered the market and sent it up, we'd be looking like geniuses right now. So it's a lot like going for two in a college football game. Let's so Ford, went the opposite way. We would rather take a 5.3% loss than continue to ride it because for some reason where we sold it is not coming up. But I believe we sold it at 14. Let's see if I can get that back. 6 months. All right. Sold it at 14. It's at 1406 and really isn't showing upward momentum after that. So that is what it is. Now, the biggest annoyance of the week, and I'm going to dwell on this for a minute because, boy, we've been licking our wounds over this. Fox. At one point, we were up about 14% on Fox, and the trend was in place, and we were doing great. In fact, on Thursday of not this past week, but the week before, it was Thursday, I believe. No, it's Friday. On Friday of the previous week, we had just raised our stop up to, I believe, pretty close to even money on Fox, where we bought it. And within 10 minutes, the price was nowhere near our stop. And within 10 minutes, the price just simply started tanking. Now, it was a Friday. It was not an options expiration day. But it's easy on a Friday afternoon to write things off like that and go, somebody's algorithmically selling a block of it. We couldn't find any news. The whole weekend went by. We couldn't find any news. We woke up Monday morning just before the market opened, about an hour or two before the market opened. Fox announced that they were buying Roku. Now, we are not here to we just don't have enough video time to go into the ins and outs of a deal of Fox buying Roku. We have been down that rabbit hole here, but the bottom line is almost invariably when a company buys another company and announces it, the company that's doing the buying, their stock goes down. The company that's being bought, their stock usually goes up. And the reason is because the expectation is in order to not get sued and placate everyone, the company that's doing the buying generally has to overpay for the company that is being bought. And for the time being, it generally turns out being a bad thing because they overbought. It may end up being a good thing over the long run. Roku is a unique asset for a company like Fox to own, but with the markets closed and only after hours trading open and available, they made that announcement and the stock just continued to plummet. And we did the only thing we could do, which was sell our shares at $52.50. We took a 9.56% loss on it. Now, we calibrate our stops here at TMC based on a maximum of 7.5%. And the reason is because we don't want to lose more than 10% of our money. 7.5% is 2.5% less than 10%. And so we calibrate in situations such as these, and we're kind of fortunate to have lost 9.56%. Really frustrating because we were actually up just a few trading days before, probably, 14%, something like that. You just don't know the future. To be honest with you, we joke around, we joke among ourselves that if we could just know the future for 2 weeks, we could actually be intragenerationally wealthy within 7 to 10 business days. We don't know the future. And so that's what happened. That one stung, but you can see Fox is $46.95. It's not $52.50 where we sold it. And so we would have done a lot worse. We finally, this Friday, got a day where there was a bit of an up. It closed up 22 cents. We are still not back in Fox. As just an aside, there's an if I'm right about this number, $866 million, almost $900 million buyout or contract cancellation fee if Roku decides to cancel the deal. There's some thinking out there that someone with big pockets, Disney or maybe the new Paramount Skydance or someone might actually want Roku for their own and might make a better deal and pay the almost $900 million termination fee. In which case, Fox would actually be handed almost $900 million in order to just simply go away, which, I mean, that would send the stock absolutely in the opposite direction. We don't have any kind of indication that that's the case as of yet. And so, anyway, we're keeping that one on just to keep an eye on it. But boy, we got lit on fire by Fox. So, enough dwelling on Fox. Global ship lease, we actually still own. We're down 1.61%. We have been up a bit, but like I said, the late part of last week clobbered us. Our stop is all the way down here at 35.82. So far, we're not really in a whole lot of danger, and we don't know what's going to happen on Monday. HP, another disappointment here. We thought we had a turn. It looked a lot like Ford, and we don't. So with HP, we got stopped out as well. We had a 4.3% loss over one day. Just a comment here, if I might. It might look like our aspiration here is to be day traders or at least swing traders. That's not true at all. We're trying to be positional traders. It's just that we cannot afford to lose money over long periods of time. And with the market extended the way it is, highly valued, and with all of the turmoil in the world there is right now, it's really tough to find trades. And so, in a way, it might not be a bad time to just simply kind of lay out. So, like I said, we're going to be looking more in the small caps going forward. That brings us to InSteel, IIIN, which has some things to like. That's a big volume day right there, and it's up at the end of the week. If we're looking at 6 months, the DI plus crosses over the DI minus. The ADX is rising slowly out of 15, and the RSI has increasing strength. So that stock has underperformed the S&P 500. You can see it in the relative strength down here. And even historical volatility is actually relatively low. You're looking at 26%. So there's a lot to like about that stock. IIIN is one we're watching. So Invesco, we're still in. We're up 2.16%, nowhere near much as we were. But our stop on IVZ is actually down at 26.36. So for the moment, we're okay. Should have done this. The MOVE index actually, I know you can't really do a trend line on the MOVE index, but the bond markets really are showing a fairly placid market. The VIX also showing a relatively placid market down in the 16s, below 17. This is the concern that the market might be breaking down a couple weeks ago, and then kind of a return to the placid market, though not as low as it had been. So MOVE and VIX index not really showing much concern. All right, MYO. We may actually be buying MYO. Talk about a small cap stock. This is 1 month, 1 hour. MYO is a wearable tech company, and I believe on the medical side, not so much just the health and wellness side. Every time it's hit this line over the last month, it's been in accumulation mode, and we just need a price kind of around in this area. Even if after hours, you can see how most of the trading on MYO actually seems to happen after hours. We got stopped out once on MYO. It's not showing up here, and I don't know why it is. Let's see if we go to 6 months, you'll see it. No, yeah, there is. We bought at $1.30. Bought at $1.39. Got stopped out at $1.30. It was a fairly unforgiving stop though, and we just kind of went for it. We will likely go for this again if we can find ourselves a decent turn. So that one is on the block for discussion this week. NAUFF. All right, let's go to 1 month, 1 hour. This is another small cap stock. It had the trend in place, and we were really close to pulling the trigger on this until late this week. It just kind of dove. This is the Canadian gold company that found antimony in tailings on the surface, and there's a lot to like here. It just depends on whether or not we can get the trend in place and in our favor. But you can see if we're doing 6 months one day, you can actually see the DI plus cross over the DI minus. You can actually see the RSI begin to point correct direction. Relative strength is in excess of the S&P 500 over 6 months. Quick, short report, if you will. So we keep PSQ, which is the short QQQ, isn't showing us that we need to pile into that yet, move into that yet. And the SH Pro Shares short is also showing that we thought the market might be breaking down, and then it just wasn't. Boy, are we glad we didn't go for it and bite right there. But we keep these on tap in case the market goes the wrong direction, because at some point with the new interest rate regime and things that are going on, we are expecting some sort of market correction. When? We don't know. So we keep going as the market dictates. All right, QLYS, we actually still own. We're up 1.91%. So far, we're okay. It's respecting the 21-day moving average. As of right now, we bought it at 109.21. Stop is at 105, so we're doing okay for the moment. We voluntarily sold our SCI. There is a lot to like about Service Corp International stock. This is a death care company. We talked about it. And we just simply bought it, we simply sold it at 74.25 and took a 5.5% gain over 10 days. Again, these short time frames are not what we're about here. But if we have to preserve our capital, and that's what we have to do, we'll do it. The right turn on this, though, and we will pick it up again. We will certainly take it. It'd be nice if we could hold something for a year or more, but I just don't know if that's gonna happen. SOXX we're still watching, but it's gotten so volatile up this way. This is the line right here where my cursor is. This is the line. Historical volatility, if you look right over here, historical volatility is about 85%. That is a really difficult stock to own. 85% volatility. In the CFA program, when they're talking about risk-adjusted returns and they're showing the ratios that put expected return over risk, I don't doubt that might have upward momentum, but it's just going to be very difficult to deal with. So we're not in SOXX right now. We have unsuccessfully tried to trade that twice. I don't know why it's not showing up for me. So I go with 1 year. Oh, sorry. Here it is. We'll go, there you go. So each of those is a stop out. We have not made money off SOXX. We just held it, but again, that's the nature of not getting good value per unit of risk. Is that with the climbing? We bought into an ETF with climbing risk and basically just got taken out because it went out of sample, so to speak. So, all right. StubHub, we are watching StubHub. This is a year of StubHub. You can see the DI plus crossover right here. The 80X go to the strong side. RSI goes strong. A dip right here, which kind of indicates a volume dry up and then a rise on volume. So we're watching StubHub. It kind of looks like this might be headed the right direction. We don't own any yet, but that might be something we do this week. TMC, the metal company, we have to watch because people ask us about it because we are the TMC. And so as the 10 mil club, it's down below its line here, doesn't really have good momentum factors. And honestly, this is just not a great stock to buy. So unless you are a really good trader, and I would love to meet you if you are, probably not going to make a lot of money off of TMC, the metals company. We may be getting back into Vera Bradley. You can see the crossover here of the DMI. And now the ATR rises, but historical volatility doesn't really move as much with it. Right there where my cursor is. RSI, though, has risen to the 60 level, and we are past earnings. If you look at 1 month, 1 hour, this is kind of an entry point. So we will probably be buying Vera Bradley again and seeing if we can make it work. We got stopped out on our last Vera Bradley purchase. Don't know why that's not showing up. Let's see, we go 6 months. There it is. We have been stopped out twice on Vera Bradley and just haven't been able to make it work. But with this in place and being behind past earnings, it may be time to make some money on Vera Bradley. And to close, Walmart is an S&P 500 stock. We bought it at what seemed to be a deal right here. It was rising. It was doing really great. And then we ended up with the Fed decision right through, or the Fed mini tantrum right through here. And it's now, let's see if we look at a year of it. It's now back below its 21-day moving average, but this is its 200-day moving average. If it respects the 200-day moving average, our stop's all the way down here, and we should be okay. So just to sum up real quick, we are probably going to be looking more at small caps going forward. We'll probably be looking at some opportunities in fixed income because the narrative is going to be that the market sells a lot of that stuff off. We've got some preferred shares we're looking at. I'm just not going to go into them this week because we probably aren't going to be buying them this week. But we just kind of got clobbered with stop outs and forced decisions where we had to simply take some profits this past week and made us look like day traders. But so it was. But that is the way we see it. So from all of us here at the production room in the 10 Mil Club, we thank you for being here, and especially on behalf of the 10 Mil Club singers, Sophie, Hannah, and Presley, and our announcer, Jackson. We will see you next time on the
10